My name is Justin Rice, certified financial planner, certified student loan professional, certificate in blockchain and digital assets. I also have with me here David Bailin, who has all of his different designations: AIF, CHFC, CLU, more than I'm forgetting. David, do you want to chime
DLTC.
in? There you go, CLTC. So we've got a lot of different education on here, but the focus today will be on taxes, tax planning, what it looks like towards the end of the year into 2025, and overall what the election has to say about all of that tax planning. I do want to make a quick shout out before jumping in to Buckingham Strategic Partners, who we partner closely with here at our firm, who created these slides. Jeff Levine presented some of these slides to us, and we decided that it would be a good idea to present them off to you. So I wanted to shout out Buckingham and thank them. So end of year 2025 tax planning, what does that look like? First, let's start with the elephant in the room. And it is a big elephant, with the Republicans sweeping the presidency, the House, and the Senate, and being able to take control over that. We now have at least a pretty good idea of what most of the policies will be if everything and all their discussion points actually come to fruition. And so what do taxes look like in light of what the election results that we just had? Well, first off, as I said, Republicans have swept, but they only have a simple majority in the Senate, meaning that they won't be able to just have broad social bills because the Democrats would still have the ability to filibuster them in the Senate. And therefore, if you can't bring something to vote, it can't go into law. But with that being said, with fiscal related bills, you have something called reconciliation, which will allow the Republicans pretty much control and the ability to pass these fiscal related bills. And you're actually probably aware of reconciliation because that's how several major bills have come into law over the past many of years. I have a couple listed here. For example, 2010, going back to the Obama administration, that's how the Affordable Care Act got instituted. Back to 2017, Tax Cuts and Jobs Act. More recently, 2022, the Inflation Reduction Act. And now, 2025, what bill do we have? We're, expectations there of some extension for the majority part of the Tax Cuts and Jobs Act, and potentially some other things as well, which we'll take a look at. But that's what we would be expecting in 2025. So the Tax Cuts and Jobs Act that was initially passed in 2017, that was actually set to expire at the end of 2025. In 2026, we would revert back automatically to the prior tax policy. However, now with the Republicans maintaining, having control of all three, it is expected that most of those current tax policies will now get extended. So what is likely to remain? Likely to remain are the tax brackets being how they are, with that top tax rate at 37%, the qualified business income deduction, which is a 20% deduction on your business income that you can qualify for. That's likely to remain. The standard deduction being elevated, because if you remember back to 2017 and into 2018, there was practically a doubling of the standard deduction. That's expected to remain the same. Child tax credits as well as the estate tax exemption to stay at quite a high level right now, hovering around $13 million per person. That's likely to stay the same. Now, one thing that is unknown is the state and local SALT deduction cap. And so something that was put into the bill in 2017 was a $10,000 cap on state and local taxes that you could take in your deductions. This really affected mostly those high tax states, and disproportionately those high tax states tend to be Democratic states. And so it was definitely put on there. However, President Donald Trump has said that he does not like the SALT cap and would like to have that removed. So it is a potential that it will get removed, but there could be some deficit hawks from the Republican side that will, because it will be not free to have the SALT cap removed. And so if you're really looking at, the fiscal responsibility and, it's already taking a lot of money to extend the Tax Cuts and Jobs Act, this would just be even more than that. So we'll see if they could actually get agreement to align that. But that actually comes to our first potential action step for today that you could consider. There will be several. But since we know this year, 2024, we will have a $10,000 cap on your state and local taxes when it comes to your standard deduction. Potentially, if you can delay your payments into 2025, that may be a good idea. And the reason for that is because if they do pass this extension in 2025, most bills are prospective, meaning that they're going to work for tax policy looking into the future. So the Tax Cuts and Jobs Act was passed in 2017, affecting 2018 tax returns. But there's nothing to say that they can't go back and a bill passed in 2025 lift the SALT cap in that year. There's not going to be too many people besides the financial responsibility on the federal government for the cost of that that are going to complain for the SALT cap being lifted. And so that could be something that they actually do retroactively. For example, if they pass a bill in May of 2025, they could say for 2025, the SALT cap is lifted. So to the extent that you already have 10,000 this year, you could look to push those things like your state taxes that you could pay either towards the end of this year or early next year. Some property taxes you might be able to shift into later next year. And so this is if things stay the same, it's going to stay the same anyway and not affect you, not going to lose anything. But if they do have a surprise and be able to retroactively count, the SALT taxes above that cap in 2025, you can give yourself a head start and boost looking at doing that next year. And again, if nothing changes, it was no harm, no foul, no benefit, but also no detraction either. Another potential action looking at around post-election results is the buying of an electric vehicle. And I'm not telling you to go out and buy an electric vehicle just because, but I am saying that if you were considering buying an electric vehicle, it may be wise to do so sooner rather than later. So they have that this is around the $7,500 tax credit that you currently get for a qualifying electric vehicle. You do have to qualify on your taxes as well, being under certain income thresholds, $300,000 for married filing jointly, $150,000 for married filing single. If you're under that, you buy a qualifying electric vehicle, you get a $7,500 credit right now. President Trump, the Republican parties have said they are not a fan of that and may be looking to repeal that specific credit in a bill next year. Now, unlike the SALT cap where they would make it'd be very weird and probably unlikely for them to have it stop as soon as they pass the bill. And so what they may do is just give you to the remainder of 2025 in order to buy an electric vehicle. But if you think about that, one of the things that you may not consider is that if people know that the $7,500 are going away and they're all going to rush out to buy the electric vehicles to try to take advantage of the credit, what might that happen is that if there's a large increase in demand, that could lead to an increase in price. And so although you're getting the $7,500 credit, maybe the vehicle's that much more expensive anyway because of the demand market value adjustments and all of that. And so if you're considering that, probably better to buy an electric vehicle in the next couple of months so you can get the best possible price on a car, including the $7,500 deduction if you would otherwise qualify for that. Now going into the planning conversations, and we kind of split them up into the perennials, things that come up every year, and then the annuals, things that are specific to 2024. We're going to go through the perennials, things that come up every year, and things that we're taking a look at for our clients every single year. And one of those things, one of the key things, are year-end Roth conversions. And by this time of the year, we're reasonably able to estimate what your income is, taxable income is, and to consider is now a lower marginal rate year, being able and opening up the ability to have us do conversions. Now, one of the things that we need to several of the things that we need to focus on, but the primary one is the tax rate, not the tax bracket. And I'll give you a perfect example of this in a Roth conversion that we just recently did for a client, or the analysis thereof, and they're in the 12% bracket. And that may seem like an absolute no-brainer to convert at the 12%, especially with massive RMDs potentially coming down the road from their accounts. However, when you look at it a little bit more closely, you see that the conversion cost would actually not just be what the bracket says at the 12%. It would actually be quite more than that, because they had capital gains that were currently taxed at the 0% bracket. So adding $1 of income actually caused those capital gains to be pushed up as well. So $1 gets taxed at 12%. But it's also pushing up another dollar into capital gains taxation, which is 15%. And so that's actually a 27% rate there. But then they have rental real estate that they take passive losses on. And as your income increases, your ability to take those losses stop. And so for every $2 of income, additional income, they lose $1 of deduction. So really, now if you're keeping up with the math, we're at 40.5%. Oh, and wait, then you have the state of New Jersey that they live in that has the pension exclusion. And once you cross a certain threshold there, they start to retroactively tax past dollars, and you can get a big spike in taxable income from the state. Now, if that didn't confuse you and make you a whirlwind already, and you understood all of that, you're probably an advisor. And if you didn't understand that, that's why people work with us, so we can properly assess what these Roth conversions should look like and make sure it's not impacting different premium assistant tax credits. You're not passing IRMA thresholds. We're paying attention to Social Security taxation, all of those things, because we care about the tax rate, not the tax bracket. And so it's just looking at coming up on year end, some of those things that you want to pay attention to. If you're contributing to 529 plans and your state allows you to take a deduction for that, it may require you to do that during the year in order to get that deduction. Salary deferrals into retirement accounts, they must be identified before year end. So if you want to make a salary deferral into a 401k, 403b, you should do that now. And then gifts. So this is interesting. So not talking about charitable gifts here, but gifts to your children, to brothers and sisters, nieces and nephews, in order to be completed by they must be completed by year end to take advantage of the annual gift tax exclusion. Now, what's interesting about that, though, is if you write a check to charity, then you're able to write the check December 30th, and as long as they and you send it to them, as long as they cash it, you get the charitable deduction in this year. With a gift to a family member, the check must be cashed this year in order to qualify for it to be a gift in this year. Otherwise, it will be counted as a gift next year. So obviously, you have the $18,000 gift exclusion this year. It'll actually be $19,000 next year. But if you want to take advantage of that, the check must be cashed in this year in order to qualify. Now, one thing about the salary deferrals is there is an exception for sole proprietor deferrals. And you can actually delay those if you don't have a plan set up yet. For the first year that you set up the plan, you can delay those salary deferrals until you set up the plan, all the way up until tax filing April 15th. And that does not include an extension. So even if you do an extension, the plan still needs to be set up and deferrals made prior to that April 15th day. Another one of these perennial discussions is tax loss harvesting. And so we look at this on a continual basis, keeping an eye on the year-end capital gains distribution from various funds, looking out for wash sale rules in the tax loss harvesting. What's interesting here is that we don't have a lot of clients in crypto. And if you're in crypto, you probably don't have a lot of losses right now, being that most are hitting new all-time highs. But if you did buy at a even higher point than we are now in Bitcoin, and now we've dropped down a little bit, you actually can make a sale of your crypto, your Bitcoin, and then pretty much immediately buy it back, because there's no wash sale rules with buying crypto directly. If you buy it through an ETF, that's a different story. But if you're buying it directly, that's not a security. And so therefore you are allowed to sell it, take a loss, and pretty much immediately buy it back without having to worry about those wash sale rules. Now, on the other side, we have tax loss harvesting. You actually have tax gain harvesting. And so, this typically brings up a question in our clients: why would I want to harvest a gain before I have to and before I want the money? Well, if you can take advantage of a 0% tax rate, why wouldn't you do that? And so the maximum taxable income that you can take advantage of the 0% bracket is about 47,000 single filers, 94,000 for joint filers. And that doesn't include that standard deduction that we were talking about before. So if you actually tack on the standard deduction of about 30,000 plus that 94,000 for joint filers, you're at 125,000-ish of income before you have to start paying taxes on your capital gains. And so that could be pretty interesting if you have some gains that can be realized at 0%, harvest that gain. And by the way, you could buy them right back because there's no wash sale rule for gains. That is only for the losses. And don't forget the kids in this. If you've got, UTMA accounts, UGMA accounts for them, you can do the same thing with their, first $2,600 of their long-term capital gains at the 0% tax bracket. Another discussion that we have perennially is checking your withholdings and your estimated taxes. Now, typically most W-2 wage earners don't have an issue with having the proper withholdings, and typically they are able to not worry about this. But if you have side income, if you have a business, if you had a liquidity event or made a large sale and had a large capital gains, you have to pay your taxes as they're owed. And so if you had taxes realized in February of this year, you owed kind of taxes equally throughout the year. So for example, if you had $10,000 per quarter that you were supposed to be paying in taxes, I mean, yeah, you could write a $40,000 check right now to satisfy that, but it was technically late because you didn't pay it timely in the first quarter, second quarter, et cetera. And so that's something that you want to take a look at when you're looking at your taxes and what might be owed into next year. Now, if you did have some under withholding there, here, some potentials for fixing it. You could do the payment now to kind of minimize the bleeding, or you could look to increase your withholdings, withholdings from your W-2 salary, withholdings from your retirement distribution, because those are treated actually as being paid pro rata throughout the entire year. And so if you did have that $40,000 bill, you could actually look to say, all right, let me take a $40,000 distribution from my IRA and withhold 100% federally, so that all of it went to go pay the federal tax, and now you don't have the penalties. But Justin, if I take 40,000 out, won't that trigger taxes and potentially a penalty if I'm under 59.5? Well, the answer is yes. And in that case, if that was the particular case and there's different rules that you want to pay attention to, you could actually do an indirect rollover of that $40,000. Because if you're going to pay the tax anyway, pay it through the withholding and then take that $40,000 within 60 days as an indirect rollover back into your IRA so that you don't owe any taxes for that distribution and are able to not have any penalties on your withholding there. So an idea of that. Another idea we'll leave you is this push and pull of income and deductions. And the typical answer here for most CPAs is like, oh yeah, let's rush our deductions. Let's see, what can we buy here before the end of the year to get some deductions? Any income, we can push it out. But I mean, that's only going to affect your 2024 return. What about 2025? If you're pushing income and forwarding deductions, that could leave you in a much higher place in 2025. And so really you want to do the full analysis here of looking at what income should we possibly accept here in 2024, especially if 2025 is setting up to be an even bigger year for you than 2024. It may make sense to pull some income into 2024, push some deductions out into 2025 if that's going to be your case. But you won't know if you don't do the math and have the forward-looking planning. Now for this next couple of slides, I've taken up the first half here. For the second half, I'm going to transition it over to David Bailin.
Right, thank you, Justin. And I'm going to think about the football games I watched all weekend and take a timeout and have a little halftime here, because we just had a bunch of things dumped on you. And I want to just stop for a moment and just say, we are going through a lot of technical material. And hopefully all you're doing right now is just gathering up different ideas and say, yep, that's something I have to follow up on, or I got to talk to Dave and Justin about those ideas, because we're not trying to teach you to become the next class of CPAs to go out and start doing tax returns. We're just trying to give you different ideas on things that you might say, this is a topic I need to revisit. This is a topic I need to discuss with somebody with expertise. So I'm about to hit you with a bunch more. Some of them pertain to individuals. Some of them pertain to businesses. So some of them may not even pertain to your particular circumstances. And if you figure, gee, I'm getting lost, it may be because it's not applicable to your circumstances. But everything that we're telling you, speaking to you about, is fair game to ask about either through an email or a follow-up meeting with us. All right, with that being said, the band has left the field. It's time now to get back in here. So let's start by talking about an area that is, I think, often misunderstood, which is home office deductions. So Justin mentioned earlier the Tax Cuts and Jobs Act that was passed in 2017 that made a lot of changes to the tax laws as we know them. And one of the things that was changed at that time was individuals who worked as employees lost the ability to take some tax deductions for business type of expenses. So when we talk about home office deduction, we're talking about people who are in business for themselves or work for a small business. And that you can see that on the right-hand side, sole proprietors, S corporations, partnerships. The trick with home office deductions is that you have to have a space that is dedicated to the business. Okay, it can't just be the family room where I'm sometimes watching TV, but when no one's around, I spread out all the paperwork and I'm working there. It has to be an area that's dedicated just to that. So as we go into 2025, think about those people who are either new in business or perhaps in 2024 couldn't qualify for this home office deduction, and say, hey, clock starts again on January 1st because I have to be able to declare my home office deduction for the entire calendar year to get to be able to take this deduction. Can I now qualify where I couldn't in the past? Okay. Other things to think about. Retirement plan contributions. So you probably know this because this happens every year, but because of the cost of living, the contribution levels that you can put into a 401k plan, into some other retirement plans have gone up. You want to make sure that you're taking advantage of those higher limits. If you're over age 73 or otherwise subject to required minimum distributions, you want to make sure that you've taken the proper amount and that you don't still require to take some for 2024. This is the time period where some employers are still in their open enrollment period. Some of them already finished up, but new year, new benefits. Some of the things that you haven't used in the past, perhaps you should be thinking about now. Things like flexible spending accounts that allow you to put aside money for medical expenses that are not covered by insurance on a pre-tax basis. Perhaps going into 2024, you didn't have a lot of medical expenses, but now you do. Wear glasses, have some dental work that needs to be done, have children that are going to be in daycare. All the above are reasons why to consider the employer benefits. Good time to review your beneficiaries and estate plans. If you have moved to a different state, that is a time to redo your estate plan. If you have had new grandchildren, if you have children who have married, all these are reasons why you want to update your beneficiary and your estate plan. And then the idea of, this seems kind of like a funny one to bring up, make sure that if you own a business that you've paid yourself a reasonable compensation. Now, for those who don't own a business, you probably don't understand the language here, but what the IRS is saying is that you need to take a reasonable compensation compared to other businesses of a like type. And you can't simply say, I'm going to pay myself $1, therefore I owe no taxes, and leave the rest in the business. I want to make sure, we mentioned flexible spending accounts. Flexible spending accounts are what we call use it or lose it, meaning that if you have a balance left in at the end of the year, that money is then forfeited to the plan itself, and you would lose your money. So you want to make sure if you have balances here in December that you find reasons to spend that money. Some plans do have a grace period that carries into 2025, but that's only for a certain number of weeks. If you have a private foundation, you want to make sure you've met your distribution requirements. We talked about annual gifts already. Justin brought that up. If you are itemizing your deductions, you want to make sure to what we call bunch those charitable gifts and other types of expenses so that in the years where you itemize, you have those charitable deductions and other expenses hit, and those years where you're not going to itemize, you don't have them. So for example, if I know in 2024, I'm likely to itemize because I have high medical expenses, I want to make charitable donations in 2024, and I may accelerate what I would have done in 2025 so I can get that deduction. Likewise, if I'm going to take a standard deduction this year, but next year I know I have some medical expenses that are going to come up, rather than make a charitable donation here in the month of December, I may want to postpone that until 2025, where that donation may be able to be deducted as an itemized expense where it would not be in 2024. Qualified charitable distributions or QCDs. Again, record keeping is real important on these things. For those who are not familiar, QCDs are contributions made directly from your IRA. It's only eligible for those over age 70 and a half, but it's a tremendous tax planning tool that can be utilized. But the record keeping on them are a bit of a bear. And come April, when you go to do your returns, you have to remember that the custodian who issued the check will not be keeping track of these. It's your responsibility. So if you don't keep track, if you don't tell your accountant about them, you're not going to get the tax benefit that you should. All right, that was the perennials. Now let's talk about the annuals, the things that are unique, things that we're going to be discussing for this year. Okay, estate tax planning concern. So as we prepared these slides before the election, there was this concern that if the Tax Cut and Jobs Act that was passed in 2017 expired at the end of 2025, as is what's on the books right now, the estate tax exemption would drop to less than half of what that current level is. So those who have more sizable estates, that was going to be a concern. We are now anticipating that the Republican-controlled legislature will continue the higher level exemption that we're at right now. So it's not as big a concern as it might otherwise be. However, it's never too early to take a look at your estate plan and make sure things are going the way you want them to go. All right, now we're going to get into an area that deals only with people who own businesses that have what's called pass-through taxation. So you probably have heard about these a lot in the news. If you don't own one of these businesses, you probably don't know what they're talking about. But they do spend a lot because these are the most populous types of businesses in the country. And a pass-through business is one in which there is a business entity, typically a partnership or an LLC, limited liability corporation, or an S corporation, where the owners, rather than paying taxes in the business name, will pay taxes in their personal name. So the business makes a profit, but rather than filing a tax return and pays business taxes, that profit transfers over to the owner, who then reports that as income and pays individual taxes. Well, as Justin mentioned before, state and local taxes under current law are limited to $10,000 per year of deductibility. So if you live in a high tax state, and I know a lot of our listeners do, these are the states of New York, New Jersey, Connecticut, Illinois, California. You've heard all about them on the news because this is a controversial part of the tax law. You know that those state taxes, state income taxes, are limited. A lot of states have put together a workaround, and you can see on the slide here, 35 states have come up with a workaround, and some of them, in addition to the 35, some states don't even have an income tax. So it's almost everybody now has a way of getting around that $10,000 cap if you own a business. And rather than go through these next slides in detail, I'm just going to give you the simple version. What the workaround allows you to do is to voluntarily pay a tax to the state at the business level. So let's take Personal Wealth Strategies as an example, which is a New Jersey-based corporation. Personal Wealth Strategies, I as one of the owners could elect to pay a New Jersey state tax that doesn't otherwise exist, reduce my profit because of that payment, and therefore to the federal government report a lower profit, a lower income, reducing how much tax I have to pay to the federal government. That tax I paid to the New Jersey would then go against my New Jersey income and would be utilized to take care of those taxes. So I'm not paying something for nothing. I am getting I'm paying taxes that would otherwise be utilized, or I'll be getting a refund. But to the federal government, I can say I made less money because I voluntarily paid this tax. These workarounds do get complicated. There's 35 states that have them, which means there's 35 sets of different rules. So I'm not going to go through all 35 of them today for everybody's benefit. But again, the idea is to know about it. If you have a small, and by the way, this could be for a small business that, today in the gig economy, you could be working as an employee full time and perhaps be an Uber driver on the weekends, or perhaps you make crafts that you sell at the crafts fairs over the weekend. There's a lot of people who have income that is considered to be self-employed. Sometimes you don't think of yourself as a business, but you could, through that income, take advantage of these workarounds. So if, again, you're not familiar, talk to Justin, talk to myself, probably even better, talk to your tax preparer who can help walk you through some of these details. Okay. Now we're going to get into one that affects a lot of people, but it is a little bit more complex. And that is, for the last 4 years, we have been in a state of flux in terms of what are the required minimum distributions that are that pertain to those who inherit an IRA. So if a person who passes away leaves you an IRA that you're now the beneficiary of, the law in 2020, effective 2021, said that you now have 10 years to take all the money out of that IRA and pay taxes on it. What the legislation did not say was that during those 10 years, you had to take a required minimum amount. But when the law was passed, the IRS said, wait a minute. We've always required a minimum amount come out of these types of IRAs. This was just an oversight. So we're going to require a minimum amount come out. And for the last 4 years, the IRS has ended up in the middle of the year saying, nope, we're going to suspend that. Nope, we're going to suspend that. Well, in July of this year, they said, we're not suspending it anymore. Starting in 2025, if you inherit an IRA starting in 2021 or later, and the person who you inherited it from was already required to take distributions, then in 2025, you will now have to start taking distributions. Okay, so you have to start taking required minimum distributions based upon your age and the balance of the account. And it does not change the fact that 10 years from the time that the person died, you have to extinguish the entire account, taking all of that money out. So I know this is complicated. If the laws don't change, and when it comes to tax laws, they're always changing. But if the law doesn't change, it will get simpler, because we won't keep saying back to this date. We'll just say whenever someone has passed away. But if you inherit an IRA, we'll just use a numerical example. If you inherit a $100,000 balance in an IRA in 2021, up till now, you haven't had to take any money out of there. But in 2025, you will have to take a required minimum distribution if the person you inherited it from was over age, was already taking required distributions. Okay. By 2031, 10 years from the time that you inherited this IRA, you will have to take out the entire $100,000 and pay your taxes. All right, I'm not going to go into any more detail than I did. There are exceptions, and you can read the slide here, non-eligible designated beneficiaries. You can say, what's a non-eligible? What's a designated? Yep, they all have definitions, and I'm not going to go through them. But if you inherit an IRA, what it means is I got to go sit down with my advisors and have them walk me through this and how it pertains to me. You don't have to learn the entire tax law as it pertains to me. All right. Secure Act 2.0 was the law that was passed in 2020 that affected the requirement of distributions. It also made some changes to retirement accounts. And one of the, I'm going to say silliest, because I think that's really the best word to describe it. There was a clause put in here that starting in 2025, those individuals who are working between the ages of 60 and 63, 4 years. If you're between 60 and 63, you're able to make a catch-up contribution in your retirement account equal to 150% of whatever this normal catch-up provision is. What that means is for somebody who is 60 to 63 years old in 2025, your catch-up contribution jumps up to $11,250. So for those 4 years, those 4 years only, you're able to make a larger catch-up contribution. So between age 0, if you start working at age 0, to 50, you're able to make a contribution to the 401k plan. At age 50, you're eligible to make a catch-up contribution. At age 60, that catch-up contribution goes up by 50%, but only for 4 years. And at age 64, it drops back down to that catch-up amount that you had at age 50. This is something that hasn't gotten a lot of press yet, but come January 1, I expect you'll hear more about it as people start figuring this out. And if you're in that category of 60 to 63, you want to talk to your employer about increasing your withholdings. All right, the other item listed on here is the retirement plan eligibility for long-term part-time employees, meaning that if you were working at a company for more than 500 hours, 500 hours is approximately 10 hours a week, more than 500 hours for 2 consecutive years, you will now become eligible for the retirement plan. Okay, doesn't matter how much you worked in 2024, this is a new benefit. So the earliest someone could be eligible under this provision would be in 2027. Okay. If you are working and contributing to a 401k plan, you're likely to see that come January 1, the amount you're contributing is going to get bumped up on you. You don't have to do anything, but if you're contributing somewhere between 3 and 10%, let's say you're contributing at 3%, come January 1, your employer is going to start deducting 4%. In the past, if you want to go from 3% to 4%, you had to take action to make that happen. Now the government's going to increase your contribution by 1% per year, and you have to take action to prevent that from happening. This is the government's subtle way of trying to push you to contribute greater amounts into your own retirement account. All right, Justin, let's talk about our special offering.
Yeah. So obviously we went through a lot today, a lot of different complexities. And so we want to help if you have any questions on this. Now, with our full client load and all of the stuff that we're already doing with our current clients, we only have a limited amount of seats available if you wanted for us to meet with your specific situation prior to the end of the year, so that we can get some of this planning discussion completed. And so that's why we needed to limit the offer today. So being here live, you have the ability to jump on it first. And then if you're watching this in the replay, if those 5 haven't been taken yet, feel free to look to claim that. But what are we giving away here? Part 1 is that year-end planning session. So a private premium session, 1 hour with personal wealth strategies, either myself, David, Ian, to be able to identify your specific concerns about your year-end planning and doing a deep dive on your goals and your strategies. And so we will just quick break. We'll be taking questions right now. So if you have any questions about the material, feel free to drop those in the Q&A. We already have a couple there that we will address soon, but I wanted to take a couple of minutes here just to make this offer to you before we dove into those Q&A. So hit the Q&A button. If you have a question on your mind that we can address now, definitely feel free to do that. Part two, as we spent a lot of time talking about taxes, I am a fan of Holistiplan. Some may call me a Holistifan if you combine those two together. But this gives you a detailed analysis of your tax return for your prior year. So in 2024, we'll be taking a look at your 2023 tax return. But what it also allows us to do is to forward things and plan proactively for 2024 to try to decide and make more informed decisions on various tax strategies like we discussed: Roth conversions, charitable giving, pooling or pushing of income, deductions. Those all can be helped to be identified through the Holistiplan tax report that you would receive. And then part three, because since taxes are just one aspect of an overall financial plan, and you don't want to do anything just for tax reasons. You want to do what you want to do to achieve your goals and do them in the most tax efficient way possible. And that's what Money Guide allows us to be able to do. So we pull all of their accounts and resources into one centralized location for planning and tracking. It's an intuitive, easy design for users to be able to look at things and be able to change and modify their goals to see how they're making progress towards their what they want to achieve. And we'll be able to uncover any potential opportunities there or hidden gaps in your financial strategy by looking at the Money Guide Pro software. And so if you want to take advantage of that, all you need to do is send us an email. My email is justin.rice@personalwealthstrategies.com, and just say, tax webinar offer, and we'll be able to get you the ability to schedule that meeting right away so we can take a look at things prior to year end and make sure you're taking advantage of all of the tax and financial planning opportunities you have before the year closes out. Because once 2024 closes out, a lot of those windows in planning will close. And so being able to have that prior to year end in this busy, crazy holiday season, taking some time to be able to do this for yourself and for your future would certainly be valuable. And so just a comprehensive, over $3,000 in value if you break it down between all the different parts. There's nothing to buy. This is absolutely free that we're giving to you as a gift for viewing this webinar. So thank you so much for attending. Now let's get into some Q&A. Let's go with this one. Can Republicans actually end the tax on tips and Social Security? Would that then increase income taxes across the board? So great question there. So that was definitely campaign promises there, actually, and tax on tips, Social Security. On the Social Security side, yeah, for retirees, it would be great to not have taxes on your Social Security. But the only problem with that is that those taxes help to pay for the trust fund. And the trust fund is already running low with projections anywhere between 2031, 2034, where that trust fund would run out. And if they don't have the taxes on Social Security to help build that trust fund, it's going to fall short even sooner than that. And if it falls short, then your benefits are going to be cut by approximately, depending on how it all works out, by 20 to 25%. And so, yeah, you might be happy in the short term by not having to pay your tax, but you're not going to be so happy in the long term if then your benefits get cut overall by 25%. And so, although that's a good campaign promise from Social Security, I doubt the fiscally responsible thing would be not to do that. In fact, we need to either add taxes somewhere or reduce benefits on Social Security in order to make it maintain viable. Neither of those strategies are popular. And so I would assume that nothing is going to happen on Social Security. I don't have any, special crystal balls or anything, but probably until we reach right before that trust fund runs out, is when we'll start to get some solutions, some painful solutions on either increasing taxes or reducing benefits. And then the tax on tips, we'll see that. I mean, a lot of the tips potentially are not getting taxed anyway if they're in cash. That's probably going, some of them are going unreported anyway. And so this is just more formalizing, what that looks like. And they're definitely, if that does happen, need to be some specific, rules and things put in place, for that. But I think that was more of a campaign promise that sounded cool. In practice, I don't think it's going to drastically help, a lot of people, but it may help some that are, getting a lot of their income from from tips. For an indirect rollover to avoid tax on the distribution that is taken with 100% withholding, would it be better to make estimated tax payments instead if you have the cash on hand? Well, yeah, if you can go back in time into your time machine and go back and make those estimated tax payments on a timely basis in the first quarter, second quarter, third quarter, et cetera, then yes. And going forward, that's definitely how you want to do that. But if it was an oopsie this year and you missed those tax payments, that's one potential way to remedy it without necessarily needing to, pay any penalties, because you're allowing to withhold from those distributions and then do that indirect rollover. So yes, the preferred method would be just to pay your estimated taxes, which is, would be hard to do now because you'd have to have your time machine to go back in time. All right,
Just to
yeah.
expand on that idea too, whenever you have a transaction involving a retirement account, it's always better to pay the taxes out of pocket if you have the cash, because if you're going to use the retirement account to pay the taxes, at the very least, you're losing the tax deferral on that money that would have otherwise stayed in the retirement account. Not always possible. I understand if you're retired and you're taking money out to live on, where would the tax payment come from if it didn't come from the account? But if you have the choice, money, generally speaking, cash on hand is not earning a lot of money, even though banks have gotten at least a little more attractive than they were. But generally speaking, we'd rather keep monies in accounts than take them out.
Yep. And keep these questions coming. We've got another one coming in here. The 2024/2025 SALT deduction was confusing. So using a real life example, how will the potential tax law change affect the 10K limit? David, do you want to keep on and share your answer to that one?
Sure. Yeah, well, sure. So the question is, there's a $10,000 limit now to state and local tax deductions. So what happens to a lot of people is, because their state and local tax are limited to $10,000 and they don't have enough other itemized deductible items to exceed the standard deduction, they just take the standard deduction for a married couple, roughly $30,000. Now, what will happen in the future? Anybody's guess. Congress could change the $10,000 limit to no limit, the way it had been, in which case, if your state real estate taxes are $25,000 and your state income taxes are another $25,000, you would be able to deduct $50,000 from your income because of those tax payments. So what's interesting about it is sometimes politics makes for strange bedfellows, as Justin described earlier. The Republicans, during the first Trump administration, passed the Tax Cut and Jobs Act through that reconciliation process that he described earlier, and put in the cap of $10,000. There was once a point where they discussed to get rid of the entire deductibility of state and local taxes, but they compromised to $10,000 limit. And immediately, there was those from high tax states that said, well, this is unfair to our state. And even though those states are predominantly Democrat, they're not exclusively Democratic. So we had people in states like a state like New Jersey, where there are some Republicans sitting in the House of Representatives who said, hey, our state's getting hit. We're in favor of lifting the cap from $10,000 because it adversely affects our constituents. So Republicans were saying we want to lift the cap. Democrats were saying we want to lift the cap. And then, wait a minute. Some Democrats, led by Bernie Sanders, said, wait a minute, this tax deductibility of state taxes favors the rich, right? Who's going to have higher taxes than the people who make a lot of income? So now some of the Democrats are saying, wait a minute, we want to tax the rich, not give them tax breaks. Therefore, we're in favor of limiting so all of a sudden the whole thing's scrambled. So to answer your question, what's going to happen? I don't know. What I will tell you is much like the answer Justin gave about the tax deductibility of tips, at some point we got to pay our bills in this country. So you can't just keep giving away tax breaks without coming up with tax revenues. So if the deduction for the state and local taxes were to be raised to a higher level, you'd have to come up with some other way to raise taxes. We're already spending more than we're taking in. Making it worse is not a solution. In
Awesome.
one humble person's opinion. But then again, I have an elementary school education and can do arithmetic.
And clearly some people can't, or, think they have a just blank check to be able to continue to spend and not have any ramifications for it. I did get a quick question. If you are a client, we're looking at a lot of this stuff behind the scenes already for you. But if you did have some questions prior to year end and you wanted to set up a conversation, you're not limited in that 5. So just let us know. You're already a client. We're already doing a lot of this stuff anyway. So let us know if you want to have a quick conversation about that, and we'll be able to fit you in. If it's for non-clients yet, if you're not already engaged with personal wealth strategies, we've got those 5 slots open if you wanted to send an email to justin.rice@personalwealthstrategies.com to be able to take advantage of the offer that we just went through. Another question
And
came
if
in.
you're,
Yep. Go
before
ahead,
you do,
David.
if you're not a client, take a look at all the things that we covered here and make sure you are getting that type of advice from the people who you do use as your advisors.
Yep, absolutely. Can you talk a little bit more about tax policies that will help small businesses? David, do you want to continue with this one, or you want me to take a crack at it?
All right, I'll take a crack at it, and then you can follow up.
Yeah.
So right now everything is hypothetical. There's we're talking about what is Congress going to do when Congress hasn't even been seated yet. There are a lot of ideas out there, but quite frankly, the most favorable ones for small businesses is for those small businesses that are passed through. And I already spoke about what a pass through entity is, and that's the majority of small businesses. Those things that keep the marginal tax rates low, keep the tax brackets low, keeps the taxes to small business low. So right now, for example, the top rate is 37% for those small businesses that are making a lot of money. But I'll use that as an analogy because it gets more complicated when you start picking middle brackets. But the top rate's 37. Prior to the Tax Cuts and Jobs Act, the top rate was 39.6, which is better. 37. So that's one. There's a lot of things that will be beneficial to small businesses that will come out of some of the regulation side of things. And I think that will be the bigger impact of small business, as a lot of the regulations are pulled back. And I know the public perception is that it's going to be the Wild West and you can do whatever you want, and consumers are going to be hurt and the environment's going to be hurt. And while there may be some truth to those statements, to a small business, having less compliance requirements, less time being spent on things that are non-productive in your business should make your business more efficient and be able to operate in a more profitable manner. So I don't know if you should look to the tax code to give a small business a lot of discounts from what they're paying right now, but I think you should look to the current administration to take away some of the regulation and continue a more favorable tax environment for small businesses.
Yep. Yep. Perfect answer, David. A couple of things I will add from just a technical aspect on the side of things, specifically to current tax policies that you could consider. There's something called Section 179 expensing. And what this allows is small businesses to be able to deduct the full price of some type of qualifying equipment or software. Because typically you'd have to depreciate that over time. You can actually take a full deduction immediately for that purchase price. And so that's something that is a tax benefit for businesses to be able to take advantage of. You have the qualified business income deduction, which we've discussed. And so that if you're a pass-through entity, sole prop, partnerships, S corps, you deduct 20% of your business income, your qualified business income. Now you have to be under certain thresholds from an income perspective, or if you're in certain industries, if you're not in certain industries, there's complications to it. But to the extent that you can, qualify for that, that is a big benefit. That was set to expire next year at the end of 2025, but now with the Republicans being in place, we expect that qualified business income deduction to be extended. Something like the state and local workarounds that we talked about, that's a benefit of having a small business. The ability to deduct health insurance in some instances, so small business owners may be able to deduct the cost of health insurance premiums for themselves and their families. And then the ability to be able to control your own retirement plan as an example as well. So being able to make those contributions, have some flexibility in making those contributions, and being able to, invest even more into yourself above and beyond the traditional contributions that we were talking about, by making employer contributions from your own business to yourself to get up to a much larger ultimate cap of about $69,000 this year. I think it's going up to $72,000 next year. So there's the ability to have these tax advantage accounts for your small business that you can put way more aside than if you just work a W-2 position. So hopefully some of those things were helpful, and we're getting some more clarity. Here's my focus: faster access, better advice from the IRS, Department of Treasury, access to my federal payroll tax payment history. This is the hidden part of waste of time for my small business. Any elucidations around that, David?
I'm hopeful coming out of the work of the Doge committee, I guess if that's the right title. There's going to be some modernization, and with the modernization, it's funny. Everyone's thinking about cutting of expenses, but the name of the group, again, I guess I think they're a committee. The name of the committee is efficiency, not cutting of expenses. So sometimes efficiency means at places like the IRS and the Social Security Administration, that their computer systems be upgraded to perhaps only a decade behind where we are right now, as opposed to, I think some of them are running almost 4 decades behind. Incredible gains that could be made by making investments into working technologies. It is extremely frustrating. Everybody on this webinar has had to deal with the government at some point or another, and it's unbelievable how inefficient state, local, federal governments, agencies are. The biggest joke, of the worst waste of time is going to the DMV, to the point where in New Jersey, the solution was to change the name of the DMV from the DMV to the MVC, thinking nobody would know that it was still the same place, just had a new name. Yes, if all those things could come about, it would be a tremendous savings to small businesses and to individuals, because you would spend less time spinning in your wheels and a lot less frustrating.